everyone, Maida here, and welcome to Australian Property Reviews YouTube channel. If you currently invest in property or are thinking about it, today's update is a big one. I'm talking about a major shift in lending from one of Australia's big banks that could affect how you structure your property portfolio. Let's dive in. So, what's going on? Macquarie Bank, one of Australia's largest lenders, has pulled out of lending to property investors using company or trust structures. Here's how it unfolded. Earlier in the week, they restricted borrowers to just one company or one trust per individual. Then, just 2 days later, they scrapped lending through companies or trusts altogether. In short, if you were planning to buy your next property via a company or trust, that route just got a lot harder. Now, why the sudden change? There are a couple of reasons. First one would be growing concerns from regulators about investors' lending risk back to 2017 levels and complex structures being used to inflate borrowing capacity. And then the second one would be the banks ended up flagging the growing trend of social media driven advice about using companies or trust structures to borrow big. They see this as a risk, so it's not just a business decision, it's partly regulatory and it's partly structural risk. Now, why does this matter to you, especially if you are an investor? Well, firstly, if you're using a company or trust vehicle to hold property, that model has now been disrupted. Also, it shows how fast bank policies can change and how much control you don't have when your strategy depends on a lender allowing something. It also refocused the conversation on fundamentals: cash flow, yield, serviceability, and flexibility. Structures are helpful but shouldn't be the whole plan. In other words, if you were heavily leaning on structures rather than the underlying numbers and capacity, this is a wake up call. Now, what can you do? Here are some action steps that you might consider. Review your structure. If you hold properties in a trust or company with borrowing under that structure, now is the time to talk with your broker or accountant and explore alternatives. Also, secondly, revisit your strategy. Run scenarios using personal lending, joint ventures, or other entity types. Stick to the fundamentals of yield, cash flow, and serviceability. Thirdly, don't wait to act. Given the change that happened, being proactive will give you an edge rather than waiting for clarity. Lending conditions may tighten, but smart investors don't wait for clarity, they move with it. And then lastly, stay informed. Keep an eye on other lenders. This move by Macquarie sends a signal that others may follow. Bottom line is, this isn't the end of property investing through companies or trusts, but the rules just changed. If you were relying on that model, you'll need to adapt your strategy. If you keep your focus on fundamentals, you'll be in a strong position. Now, if you did find this helpful, please hit that like button, subscribe, and if you haven't already, comment below. Thank you for listening. I'm Maide, and I'll see you in the next one.